Thank you, Chris.
Andrew, we'll start off with you. Cash flow, obviously for most property investors, it's quite a major thing. What are some of the most important things about it?
Cash flow is a really important part of the process because buying a property is only stage one of the process. And once you have a great property, then you've got to be able to cash flow that property. So the selection of the right property is important. Where your money goes into and where the money comes out of is a really important part for cash flowing your property. If you get it wrong, then cash flow properties can, the cash flow that you have can cause difficulties. For example, negatively geared properties, which are abundant in Australia because rents aren't quite as high as they once were as a yield. And if you put the money into the wrong places, take it out of the wrong places, cash flow issues can occur. One of the examples that a lot of people do is that they put their rent and their salaries and they put it all into their home loan thinking that's going to get rid of it much more quickly, so the home loan is paid down more quickly. But the problem is that when they do that, they then pull all of their expenses out of that one account. So sure, they take their living expenses out of their home loan and they also take their their loan repayments and all their outgoings such as rates and insurance, body corp and so on out of that same account. So they might put $1 of rent in and pull $1.20 of interest out and another 30 cents of expenses, and suddenly you're 50 cents down, and suddenly your home loan from going downwards is starting to move back up. And there's also implications for tax on that because you're effectively taking your personal non-deductible debt and putting deductible debt into it and mixing it up, and it's not claimed. So it really does cause some problems in getting it wrong, and if you get it right, it can really change things around and make it a lot easier for you as an investor and to pull it all together.
And so when you talk about finance structuring, that's really setting it all up to know which is your offset accounts, what are your split loans, and where the money comes in and where it comes out.
Absolutely, because if you get the right products and you get the structure right, then you can manage your money flow a lot easier. Now, what money flow is where you take money into your accounts from, say, your salaries and from your tax credits and from dividends and other sources of income, and also your rent and where that money goes into. So typically you might put your salaries bring your salaries in and you put them into your home loan or an offset beside the home loan, and then you pull your living expenses out of it. Then you set up a separate account which is independent so that you can run the business of property investing like a business. And you set up an account for that where you put your rents into and you pull your repayments out of that. And you keep the two separate, and it's much easier to manage, and your cash flows a whole lot better. And your home loan, instead of going down and then coming back up past to where it was because you're supporting an investment property, it just goes down, and you're treating your home loan as if you haven't got your investment properties, and then you're treating your investment properties separately with their own facilities.
Now,